there's chances that one of these account types is most likely going to be better for you. So you want to favor a traditional tax deferred account if you're a high earner in your peak earning years, if you have a high savings rate and FIRE aspirations, if your investments are your primary source of retirement income, so you don't have pensions, you don't have rental income, you don't have royalties, if you have significant charitable goals, tax deferred accounts are great. If you have more heirs and or you have heirs with lower incomes, and again, the idea is if you die with this money in the account, your heirs are going to have to take it out over 10 years. And so the more we can spread that out over multiple people, and if they have lower tax rates because they don't have high of incomes, that could be more beneficial. And again, if you live in a high income tax state and you might relocate in retirement, tax deferral could potentially let you save, kind of leveraging the federal tax benefits and get some state tax benefits. As far as when you might pay less, and when you want to use a Roth account, if you're able to save or convert in your lower earning and thus lower tax years, so I would call that like 12% or lower, and that's a very general guideline because you want to look at the specifics of your situation, particularly like if you're an early retiree, going to the top of that could make you lose your premium tax credit. So this is not specific advice to anyone. This is something you want to look at closely with your planner and maybe your accountant before you make that decision. But just as a guideline, what I would consider low rates. If you plan on working to traditional retirement age or beyond, again, the idea is your earned income is going to be filling those lower tax brackets. And so you might not benefit as much by deferring and paying your taxes later. If you anticipate having high income in retirement from pensions, rental income, royalties, a large Social Security benefit, if you're going to be retiring later, again, that's not a bad thing. That's a good problem to have, but it's going to make it less likely that you're going to benefit as much by deferring your taxes. If you have legacy goals and they are not charitable, so you're thinking about giving to your kids or other family members, and the less heirs you have and the higher their incomes, the more likely they're going to pay higher taxes later. So you might want to lock that in at your rates now and then get that tax-free growth like we talked about. And then finally, if you live in a low or zero income tax state and you might relocate in retirement, if you pay your taxes now on the state level, you might be able to avoid them at a later time, and that could work to your advantage.